Hey YouTube, what's happening? It's Richard, founder of Short-Term Rental University and professional real estate developer. And today we've got a really special segment. I'm proud to announce that Clint Coons, a founder of Anderson Business Advisors, is with us here to talk about all things related to short-term rental and the tax implications. So Clint, thanks so much for joining us. I know you were on a podcast with us about a year and a half ago, and many of our followers and audience members have signed up for your service and you're handling their taxes. So thank you in advance and welcome.
Hey, thanks for having me on. I appreciate it. We got a lot of information to cover.
Yeah, so let's turn immediately into sort of short-term rentals and taxes and tax implications. Like I said in the introduction, I know that many of the people that had listened to the podcast have contacted you and are now working with you for, proper tax filing, accounting, and in specific, I think what most people care about is tax savings.
Yes. Yeah, I know taxes are huge. There's no doubt about it. When you're in short-term rentals, you have to be aware where the taxman sits, or he can come back to bite you later on, and you'll be shocked to know you could be giving away a lot of your profits.
Exactly. And so maybe you could start with sort of what are things that many people may or may not know are tax deductible. So as they're working with their bookkeeper, what items should they be flagging? And just tell us all, from cars to meals to travel to conferences to depreciation.
Yeah, all right. So when it comes to tax planning for short-term rental property, the first thing you need to understand is that how they're going to classify the income. Because so many people get caught into this trap of not appreciating the fact that when you're engaged in short-term rentals, that's active income to you. And I see a lot of people make this mistake over and over again. They want to get started in the business, so they go out there, they find a property, or they're leasing a property, then they're going to sublease it back out, and they start bringing in income. And either they're doing it in their own name, or they're doing it through, most likely, a limited liability company. And what they don't appreciate is that all of that income that's coming into them, that is active income, which means this: it's ordinary income, tax at your ordinary income tax rate, plus it's going to be subject to employment taxes. And what that means is that you're going to pay an additional 15.4% on all of your taxable income. So you can go out there and you can find deductions, but the key issue that short-term rental people have is that they first need to figure out how to control that income at the outset. So then when it comes down to the deductions, we have a much smaller amount of income that we have to work with that would be considered active to us. And I mean, we run across people all the time in this space that when we look at their tax returns and we see that income on there, it's been mischaracterized, it's shown up on Schedule E, and really it needs to show up on Schedule C. And what's going to happen is they're going to be involved in one audit, and that auditor is going to come, they're going to spot that, and then they're going to go back and they're going to reclassify all of that income, hit you with late penalties, failure to, not failure to file, but late penalties and interest by not properly characterizing your income. So that would be the first step. And what I would tell people to do is you want to make sure they have the right structure in place. And what that means is that you're not going to use a disregarded LLC. You're not going to use an LLC tax as a partnership to run your rental income through. You want to run it through an entity that's treated as a corporation so that you're taking a portion of that income. So you don't want all of it hitting your books as active income, but you're taking a portion of it, and then you're going to filter it down to yourself through payroll, through reimbursements for various expenses that you'll be incurring, and then write-offs, like you said, vehicles, things like that. So that's the key component here for short-term rental individuals, is making sure they're in control of their income.
Okay, so let's just stick with that for a second, because one of the things that I've always heard is you don't want to be taxed as a corporation because it's a double tax.
Okay, so the biggest mistake that I see people make is believing that corporations, for example, C corporations, have this dreaded double tax. Let me show you what I'm talking about. So let's assume this is your corporation right here. All right, this is a C corp, and it generates $50,000 in income. So it has $50,000 sitting inside of there. Now, if you don't do anything and you let it sit there and you're going to pay tax on that at 21%, then whatever's left you decide to take out of here as a dividend to yourself as the shareholder of the corporation. Granted, that's double tax. But the thing about it is that with this double tax is I'd have to ask you, where do you live? Because sometimes this is actually going to be lower in many instances when you decide to pull the money out than it will be if you just took it in your own name originally, because between state and federal, you're in a much higher tax bracket. So you have to be careful there, and just assuming that paying tax at the corporate level at a flat 21%, then paying tax in my tax bracket at 20%, which equates to 41, is somehow going to be higher than if I earned it just directly in my own name. I dealt with an individual who was in this dilemma. Their CPA had them set up with an S Corp, and they're making $1 million a year, and between state and federal taxes, they're over 50%. And my whole point was, hey, you need to move to a C corporation because your effective rate there is going to be about 37% with the double tax. And so we made a change for them to help reduce their taxes. But anyways, so that's how double taxation works. But what people miss out on is the fact that when you take this $50K, and if you don't do this, if you start paying yourself out as a salary, that's a deduction. So if I paid myself out a $50,000 salary, like that, then I have zero income, so the double taxation is not an issue. Or maybe I have a vehicle expense that I'm reimbursing. I'm keeping my mileage. I'm keeping track of the mileage. So I spent $15,000 just driving my car around. That's a deduction to your corporation. So that helps reduce the income. So the only time you have this double taxation issue that everyone gets so hot and bothered about is when you let money sit inside of the corporation and you don't expense it out. But the fact of the matter is, sometimes it's better to leave the money in there than it is to take it out, because if you're in a higher tax bracket, you don't need the money. Why not leave it in the corporation to help it grow your business? So that's the way I'd look at it.
Okay, now one other question that I know many of my followers have asked regarding active income is, so in most of my real estate investing, I have losses, right? They might be positive cash flow, but after depreciation expense, one of the benefits that I believe you only receive if you own the real estate, as opposed to, you mentioned earlier, subletting it out, or traditionally known as rental arbitrage. But basically, most of my followers own a lot of their real estate, and so we have this big depreciation expense. Now, in the short-term rental market, my understanding is because it is active income, it can also offset other ordinary active income. So if a short-term rental generated $10,000 of cash flow, but after depreciation expense shows a $10,000 loss, that $10,000 active loss can offset a W-2 ordinary income, dollar for dollar. Does that sound consistent with your understanding?
So in that case, if you were listing it all on Schedule C and you were showing a loss, then yes, you would be able to take that loss on your 1040 and apply it against your other forms of income. So typically what you're going to find there is that if you're not or materially participating in real estate, which would be someone who has another W-2 income, they're not spending the requisite 50% of their time, 750 hours a year on rental real estate related activities, then the only way you're going to be able to pick up a loss from this type of activity is to structure it so that it does show up on your 1040 Schedule C. So the Schedule C losses then can be used to offset other income. That is correct.
Which is extraordinarily advantageous.
It is advantageous, but here's the thing that I run into a lot when I look at people that are engaged in short-term rentals, is that their income always exceeds their depreciation. Even if you come in and you do a cost seg on the actual property itself, which is just going to affect you in one particular year, so you're front loading all your deductions up front when you're in a high tax year, still at the end, when it starts going out over time, you're going to find that that income you're pulling in from your rental income versus your depreciation, it's always going to be positive. At least that's what we've seen the majority of the tax returns that we prepare for people in this space.
Yeah, and I think that a lot of the question comes from whether people are holding this purely for investment, in which case I think what you're saying is right. But there's a lot of people that use this for like a vacation home strategy, a way to get a second home or a third home. And so they're not necessarily maximizing income per se, but there's they use it for less than 14 days, and then they've got the depreciation expense, and you add it all together, and the property can positively cash flow and yet show a loss on the tax return and offset their, let's say they're a lawyer on their day job. It can actually help reduce their taxes overall.
Could. Now, see, when you say if you're going to rent it out for less than 14 days a year and you treat it as a residence, then what you could also do is just not even claim that income. on your personal tax return.
Use it for less than 14 days, but rent it the others.
Oh. Yeah, okay, I understand. Yeah, you're correct.
Okay, and so tell us a little bit, because people join us from all over the world and different places in terms of their knowledge of finance and taxes. But what are some expenses that they should speak to you or their accountant about? And what are some absolute yeses and some like no's?
Well, I mean, the way I look at things when it comes to taking deductions through your business is that start with the premise that everything's going to be deductible, all right? And then we work backwards from there. And so many people make this mistake over and over again. They get so caught up in the weeds. Oh, can I write this off? Listen, if you can figure out a way to tie it back to your business, then it can be deductible. So I'll give you some examples then. Education, that's a big one. So when you get started in this space, you're going to work with people like yourself who's knowledgeable, that can provide value and benefit to help me grow my business. Now, a lot of CPAs will tell you you cannot deduct that education expense. And that's the number one missed deductions that we find on tax returns and working with people that are learning how to invest in short-term rentals, is that they believe that they can't deduct it unless they're already in the space themselves. Well, the answer to that is demonstrably false. As long as you create a business around what you're doing, and this would lend itself to creating an entity now, you set yourself up in the business, then it becomes a deduction to you. So that's the number one missed deduction that we often find. Of course, travel to and from when you're going out, if you're looking at properties, you should be writing that off. Something to know as well is that when you travel for business, as long as you spend more than 50% of your time in a given location on business-related activities, then the entire cost of your travel would be deductible. And so what we find, or what we strategize with people on is, let's say that I live over here in New York, and I want to go look at a property in Utah. Well, while I'm in Utah, I like to ski. So why not structure this? You fly out of New York on a Wednesday, and you go to Utah and you spend 3 days looking at properties. So you look at them on Thursday, Friday, and Saturday. And then you take off and you ski on Sunday, Monday, and Tuesday, and then you fly home on Wednesday. Now, I said you have to have 50% of your time on business. So the way you could average all this out is you would look at, all right, the flight from here to here, that's 1 day, plus 3 days on business, plus 1 day flying back home. So that's a total of 5 days that will count while I'm there on business. Then I spent 3 days playing, skiing. Therefore, the entire cost of my trip is deductible when I go out there, the entire travel cost. Now, if you want to get the hotel cost deductible, what you should do is set it up so that you have meetings on Monday and you have meetings on Thursday and Friday. So you sandwich it in. Then on the Saturday and Sunday, have no meetings, spend that day playing, and you can even write off your hotel stays during that time. So travel expenses is an oftentimes missed expense that we see that people don't pick up on, because some CPAs will look at it and say, well, you didn't buy a property when you were out there. You don't have to. As long as you show it's part of your business that you're investigating, looking at certain areas. Now, you need to document it. All right, so you need to have a ledger stating who you met with, when you met with them, and how long you spent with them. Pick up flyers is what I would recommend as well. Again, everything you can do to substantiate the travel while you were there. So travel and education are two huge expenses. The other one is, we talked about depreciation when you have real estate. Everyone's is accustomed to the standard depreciation, but when you have certain properties that you've held for a couple of years and you want to accelerate your depreciation, something you could do with residential real estate is what's called a cost segregation analysis. Is where we look at the property and we determine how much of that property can we accelerate the depreciation on, so we can get you greater deductions sooner. And this comes up many times when people are in years where they have a lot of taxable income, they're looking at ways to reduce it. We'll come in and we'll pump up the depreciation through what was referred to as a cost segregation, and will help eliminate a lot of that income in those high tax years. Most CPAs will tell you this has only been done on commercial property or multifamily property. Well, the fact of the matter is it's also available to residential property. And so that's a oftentimes missed deduction. We've done a lot of those in the last 8 months for our clients, and they've just been amazed at what we're able to pick up for them on their tax returns for their residential real estate. So those are three of the big ones that I would see when it comes to for real estate investors that are in this space that are missing out on tax deductions. Pretty much everything else is just as long as you can relate it back to your business, it becomes a deduction. You talk about clothing, all right? So if I wanted to write off clothing, how would I go about writing that off? Well, come up with a logo for your business, right? And then start putting the logo on your clothing. Now it goes on your tax return not as a clothing expense, it goes on as an advertising expense. You're a skier. So what would I do? I would put the logo on my jacket, on the back of my jacket. So you go out there, you buy a high-end jacket, and then you put a logo on it. Now it becomes an advertising expense for your business. So it's just a matter of how you look at things. You can tie it back to your business that I think is really important in this whole scheme. So pretty much anything can be deductible as long as you find a way to do it. I mean, refrigerators, I talk to people about this a lot of times. You got a refrigerator in your garage. Well, why could you make that a deduction? Sure, because you have business meetings at your house, right? You invite people over, you want to talk about short-term rentals and how they could get started, or maybe they're already in it and you're doing some brainstorming sessions together. Well, what do people like to drink? Cold beer, cold sodas. How are you going to keep it cold? You got to have a refrigerator to do it. So as long as you can tie it back to your business, now it becomes a deduction. So that's the mindset you have to get into when it comes to running your business. Take the approach that everything's going to be deductible unless it's so personal in nature that there's no way for me to justify it.
Cool. So if we could just drill down for 1 second on the cost segregation, because I think that's an area where commercial real estate, multifamily, to your point, have been doing that for years, and that might be, really valuable for them. In the single-family home or the short-term rental space, I mean, it probably doesn't make sense for a $100,000 home. Like, where does it start to make sense? Is it a $1 million home?
It starts to make sense on those properties that are about 175 and greater. Once you get about 175 and greater, then you're going to start seeing some things pick up. The sweet spot you're going to find is, $500,000. I have a client has 4 of those homes, and I think we save them about $37,000 by doing it. So you're right. $80,000, $100,000, it's not worth it. But once you get about 175, then you start seeing some benefits. And before you do it, what any provider should do for you is they're going to give you an analysis. They're just going to basically look at it and tell you whether or not it's worth even going through the process on that property.
And is that process expensive?
No, typically it's not. You're going to be looking at a couple $1,000 depending on the value of the property to do it. And so then it comes down to cost benefit, right? That's why what I meant by the provider you're working with. They're going to say, hey, it's going to cost you $1,800 to do a cost segregation, and it's only going to save you $1,900. So you're only really saving $100. But if they look at that property and say, you know what, it's going to run about $1,800, but I'm pretty sure we're going to be able to save you $12,000, well then definitely the numbers are in your favor.
And now this is as a result of some of the tax laws that I think are in this current administration, right? Like advanced depreciation.
Yeah, you've got some accelerated depreciation there on certain things, but really this has been around before the tax law changes, but just nobody was taking advantage of it.
Oh, amazing. So are there things in this current administration with that accelerated depreciation that viewers should be following or thinking about?
Well, that's going to be a lot on leasehold and the way you're structuring your leasehold improvements. So if they are leasing property, you have to be really particular. You want to strategize on how you're setting up any improvements you're doing to make sure that you can write off those improvements 100%, because there are some traps inside of there. So typically what we do is we have an individual that is leasing property in the short-term rental space, and then they're going to sublease it back out. We have them work with our tax department if they notice that there's any improvements that need to be done to the property to make sure we can deduct those 100% in the first year.
Cool. Okay, well, I think this is, from the start what we should be thinking about, and I love the concept, and I do this personally. I start with everything as a business expense until it's not. One of the single best ways to increase your profitability is to pay within legal allowances, always staying on the right side of the law, but using all of this knowledge that you and your firm have to our advantage. And it comes down to education and partnering with the right people, right? Like, we don't know this ourselves, but through strategic planning, we have access to people like you. And I guess one of the questions that I would have is, I've often found that my relationships with my accountants and CPAs are filing, and it's like, hurry up and let's file and let's meet deadlines. And there's not enough planning and preparation and strategizing and analysis. So tell us a little bit about how your organization is set up to understand the entrepreneur's needs and their personal opportunities so that it's removed from just purely filing only.
Sure. So one of the things that we do that makes Anderson unique is that we look at real estate investing as a three-legged stool. You've got asset protection, you have tax planning, and you have business planning. And so when we're working with an investor, we're paying attention to all three aspects of that stool to make sure that whatever plan we're creating is going to help you grow your business. Because so many people can get caught up just in asset protection or tax planning and then lose sight of the fact that they want to continue to grow their business, and they find that it actually prevents them from moving forward. Because at the end of the day, one of the things that help us grow our business is access to other people's money or banks, lending, finances. And the structures you create or the way your tax returns look to underwriters can either help or hurt you. And so there's multiple layers to this. And what we do at Anderson is that we parse through those multiple layers and design a strategy around where you want to take your investing, how you want to grow your business, and then find an optimal solution that's going to help you get there and achieve it much quicker than you would otherwise. Because when those roadblocks come along that most investors are going to be tripping along their way to growing their portfolio, you've already dealt with that. And so it won't be an impediment to you. So at Anderson, we focus on that, and the way we do it is through strategy sessions. We sit down with people before, we don't charge them for this. As a member of Short-Term Rental University, you can have a 30-minute strategy session with us, and we're going to look at your plan and what you want to accomplish, and we'll lay everything out for you in a blueprint and show you how to do it.
Awesome. Well, thank you so much for extending that to our audience, and I hope a lot of people take advantage of that. Again, see what it is that you're currently doing under your current CPA, and take a look at what Anderson and Clint can put together for you that's personalized for you. And if it makes all the sense in the world for you, act on it. If it doesn't, then stay where you are, right?
Absolutely.
Cool. Well, look, I think that this has been extremely helpful to just get people an understanding of some of the different opportunities that we're seeing in the short-term rental space, what makes short-term rentals active versus not, and then also some of the enhanced strategies. I really appreciate you taking the time to share with us about cost segregation. I'm the first to admit I thought it was much more useful in commercial real estate or larger transactions. I'm really surprised to hear that it makes sense, at a $200,000 home, but that's incredible, because if people have a really good tax year outside of their short-term rentals, maybe they're lawyers or doctors or whatever, entrepreneurs, that's a really strong way to reduce your taxable load. And I know a lot of people in the multifamily segment in particular, with great pride and joy, say that they get, like $1 million refund this year, even though they had this much cash flow. And it's due to those advanced strategies and bringing the depreciation expense earlier.
Absolutely.
Cool. Well, thank you so much, Clint. We're going to include the link in the description for people to get in contact with your office, and I really appreciate your time. I'm really also thrilled, just to tease this for the rest of the audience, that we're now going to turn and we're going to film a second episode on asset protection strategies to ensure that all your hard work doesn't get eaten up because somebody had a slip and fall and you weren't properly set up. So I'm excited to record that with you, Clint, and I thank you very much.
Thanks. All right, let's get on it.
Thanks so much for watching that video. I just want to share with you that the HostSaver one-click website tool is now live. People are on it, they're using it all the time, and we really want to encourage you to take control of your financial future by building your own brand and building your own business and getting off the dependency of the platforms. Take charge and control of your own future and develop relationships with your clients, the people that have come and stayed in your home. Tell them about discounts or specials that you have. Tell them that you expanded. Tell them anything that you want. Write blogs and start to get your own traction, right? Attract your own tribe using your own website. This is what businesses do. It's 2020. The time is now for people like me and you to build our own website and become platform agnostic. So go ahead and click in the description below to register for the HostSaver. One click and you have your own custom, absolutely gorgeous, works flawlessly website. Can't wait to see you there. Let's go, friends.